start the conversation as early as possible, put a plan in place because I can tell you how many clients that we talk to, they're like, oh, I found this house and I want to put in an offer, but then we go ahead to put together, start putting together the pre-approval letter. And unfortunately, they don't qualify and it's going to take 3 to 6 months. So, the earlier we can get out ahead of that, the better.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show, you already know what to do. Leave us that rating and review and give us some honest feedback. It helps us, but also helps other listeners find the show and get the value you need to be a great investor. Listen, if this is your first time listening, be sure to hit that follow or subscribe button so you don't miss an episode. Now, we got a great show today. We're going to be talking to Jeff Welgan. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Jeff Welgan has over 20 years of experience in the mortgage industry and real estate investing. He's an expert in residential 1 to 4 unit through conventional and non-conventional lending using short, mid, or long-term rental strategies. Now, he has been a guest of the BiggerPockets Real Estate Podcast and the Rookie Show, and he is a leader of the team that helps so many people, including Tony Robinson, scale his business. Let's welcome to the show, Jeff Welgan.
Thank you, John. Appreciate the invite. And yeah, it's an honor to be here.
Absolutely. Hey, Jeff, I went over your bio at a very high level. Take 2 minutes to fill in some of those gaps.
Okay. Yeah, sounds good. A little bit about me. Again, I've been doing this for 20 years. I built a team dedicated to solving problems for real estate investors, and a little bit of the backstory on how I got here and why we're talking. I've been working with real estate investors the majority of my career, and I grew up in Southern California. And I had a group of investors in LA that were the first to see the vision out in Joshua Tree and started buying short-term rentals about 10 years ago, hand over fist out there. And to be honest with you, I've been kicking myself ever since for not following their lead because they've done very well over the last decade. But that ultimately led me to the tiny home builder out there that builds a lot of the tiny homes that I'm sure a lot of people have seen on social media. And I became his preferred lender in the late 2010s. And then when Tony Robinson with BiggerPockets, the real estate rookie podcast host, and his wife Sarah were getting their start in 2021 and were having lender troubles, my builder buddy introduced me to them, and the rest has been history. So I really helped them build their business and scale it up and really help them connect the dots on the lending side. And then in turn, I've been going and actually doing some public speaking at some of their events, which led me to BiggerPockets. I've been on the podcast 3 times now, and it's been a lot of fun. So it's been quite a ride over the last couple of years. I've been really enjoying it.
I love it, man. I love it. Well, let's talk about that, right? So you're an expert more in that 1 to 4 unit space, which I love. I mean, that's exactly how I got started. My first project was a 2 unit that we house hacked. Love that strategy and push everyone to do that. So talk to us, the 1 to 4 unit space. What are the things that someone should know about investing and kind of the lending options that are available today?
Yeah, so I mean, to start, the biggest thing I like to get out there is how easy the government is trying to make it right now if, you are looking to buy a primary residence, 1 to 4 unit, and they have opened up more money that's available right now than we've seen since, the, mid 2000s. We're really going through a period very similar to coming out of the Clinton administration, coming in the mid to late 90s through the mid 2000s, leading up to the Great Recession, where the big push back then was to get as many first-time home buyers and low to moderate income families and renters into homes so they could experience the American dream. The big difference between that time period now is we have the same type of down payment assistance money and grant money that the government's rolling out, but they've really tried to slow down real estate investors a little bit. They've made investor financing a little more expensive this time because we have such a supply crunch. So what that really means to investors and multifamily investors that are looking at 2 to 4 unit buildings, when we're looking at the ease of qualifying as a primary residence, most of our investor clients that are just starting out, we work with investors from, investor curious that are just starting all the way up to seasoned investors, that have hundreds of doors. And for our clients that are just starting out, right now they have opened up a program here over the last year and a half. That's the 5% down Fannie Mae option, where you can put 5% down up to 4 units and live in one of the units. And a lot of our clients will use what's called the annual move up strategy, where you buy a property, you live in it, whether it's 1 to 4 units, you live in it for a year, and then you can turn that into a rental property and buy your next one. And so this is the way a lot of investors early on will get their start, that have the flexibility of moving every year. And I have one client that's done this 8 times over the last 12 years. And he finally got married, and his wife put his foot down and said, no more moving. But it's a great way to build a business. It's a slower way to scale, but it requires the least amount of capital, because you're coming in with somewhere around 5% down on each of these properties. So it's a good strategy that I like to get out there, that I know a lot of investors know about, but it, especially for the early investors that are looking at real estate investing, and it seems like the barrier to entry is a mile high. Even doing a primary residence strategy, it seems like, oh, I've got to come up with all of this money. The reality is that it has not, like I said, not been this easy in a very long time, because the government, for our clients that have not bought a house, or haven't owned a home in the last 3 years, there's down payment assistance money nationwide, where we can go up anywhere from 100% financing to 105 on single units. On duplexes, we can go all the way up to 101.5% financing. So that means you can buy a duplex with, very little money out of pocket, and live in one of them and rent the other one. You can do a short, mid, or long-term strategy. Or alternatively, if you have 5% to put down, you can do a 3 or a 4 unit, live in one of the units for a year, rent out the other 2 or 3, and then you can go buy your next one. And you can theoretically have 8 doors within a 10-month period. If you were to, buy a fourplex, live in one, then buy another one a year later, you have 8 doors. And so this is a way to scale with very little money out of, or the least amount of capital required. And this is one of the strategies that I really try to get out there, because we have investors that have been taking advantage of this since this program rolled out
And
here
I,
last
and
year.
I love these strategies because I mean it's a great way to get started, as you mentioned. Lots of different approaches there. You talked about the 5% Fannie Mae product that's out there where you can buy a 3 to 4 unit property, get your small multifamily, and continue to rinse and repeat that strategy so you can start to build a little small portfolio. But you can also get down payment assistance. So let's talk about what it takes to qualify for some of these things, because some people may assume that, oh, okay, that sounds great, but you probably have to, meet or be below some sort of income threshold. Start with the 5% and then
Mhm.
talk about kind of the down payment assistance. Like what does it take to qualify, or what are those restrictions?
So with the 5% down, there is no minimum or max income requirement to qualify for these programs, like some of the down payment assistance programs that are available. So with the 5% down, you do need to fully qualify for this. This is a full doc loan. You don't need a W-2 job, but you need some kind of documentable income. And there's ways to get very creative and strategic with this. So we have clients that, are self-employed or W-2'd, or may have a co-signer come on to help bridge the gap to increase your buying power. And the nice thing is we can use the rent from the other units to help you qualify. So it's not as difficult as most people think. So that is the one aspect with the multifamily, the 3 and 4 units. With the down payment assistance, it varies, because the way the government currently has it set up, each state has their own HFA. It's our housing finance agency that governs down payment assistance. They're working on a DPA 1 that's going to be a nationwide, standard for everybody. But as of right now, the best advice I give everybody is check with your local, where you currently live, to see what's available. You can always reach out to us, and we can, let you know what's available state by state. We're licensed everywhere except for New York, so we, lend in 49 states. And with that being said, the down payment assistance programs, they will vary. Some are, free money, others have to be repaid. Some, like out here in California, we have an equity share program. So there are different variations, and they all have their own requirements to, minimum requirements or income limits where you cannot exceed a certain threshold. But we do have one program that was rolled out last year, which was a game changer for investors, I really like to get this program out because it allows us to go up to 101.5% financing on duplexes. There's no minimum or maximum income limit. So with a lot of the down payment assistance, there's that maximum limit where you cannot exceed a certain threshold. With this program, there's no maximum, so you can, be making plenty of money, and you can also own real estate currently. So this one was a big game changer for real estate investors because most of the down payment assistance programs have a first-time home buyer requirement, which means that you cannot have been on title to a home in the last 3 years. Not, I've never owned real estate, but just not in the last 3 years is the first-time home buyer requirement. But with this program specifically, there is no first-time home buyer requirement. You can own a house now and buy your next one with down payment assistance as long as you've lived in your current home for a year.
And does this one require you to be owner occupant?
It is. Yeah.
Okay,
Everything I've talked about so far is owner occupied. These are the
got
primary
it.
residence loans. And this is really the easiest way to get into real estate investing. I mean,
Yeah.
we all need somewhere to live. This is a good way to buy your first property, get your foot in the door while you're saving money to buy your next one the following year. And, this is again, the lowest, capital requirement to buy your first property. As you start buying more, there are other obviously alternatives that we'll talk about here in a sec. Once you have a larger down payment saved up.
Well, and you think about it, I mean, when you can get, 101 and a half, financing, I mean, that's incredible, right? I mean, this is pretty much no money down type deals or getting a little bit of money. And for some investors, that may be almost scary the other way. It's like, whoa, wait
Yeah.
a minute, doesn't that feel like too much, right? But I think the point here is that the government is really incentivizing home ownership and trying to create situations
Absolutely.
where more people are in a situation where they can go out there and buy their own home. And if this is you, here's a great way to get started. I know for me, our first property with my wife and I was a duplex in Chicago. We got it with an FHA loan. We only put 3.5% down. And I didn't know these kind of products existed. So we were saving money. We expected to have to put at least 10%. We thought we'd probably have to put 20%. So when we found that property and found out we could get it with just 3.5%, we were shocked. But it also allowed us to take the extra money we had saved and use it for renovation. So that allowed us to create a lot of equity and it kind of got the ball rolling for us. So it really is important to get started, and I think so often people wait and, I got to wait for this, I got to wait for that. You're listening to Jeff talk about the different strategies and different products that are out there. You don't have to have a whole lot of money day one to get started as a real estate investor if you're using these strategies. So, can you just talk about maybe the FHA loan and maybe how that compares with the Fannie product you just mentioned?
Yeah, it's a great question. I'm glad you're touching on this. So this was the big difference or the game changer because with the FHA loan, like what you used years ago, back, let's say 5, 10 years ago, it was a relatively inexpensive loan, and they have increased the mortgage insurance premiums on these significantly. So there's two things that, and then when you're looking at multifamily, so you can do a 3.5% down FHA loan on 2 to 4 units. But on the 3 and the 4 unit option, there's what's called a self-sufficiency test, where when we look at the 3 and 4 units, the rent of those units, even the one that you're going to be living in, needs to cover the all-in mortgage payment, the principal, interest, taxes, and insurance, and the mortgage insurance. With rates going up, it's become much more challenging. And then if you're anywhere in a higher purchase price market out by the coast or in the big cities, it's very difficult to get any 3 or 4 unit building to pass that self-sufficiency test. And so it's been that combination of things that has made that a less viable option because again, they've increased the cost where you've got to pay a large upfront mortgage insurance premium and a monthly amount because that monthly amount doesn't cover the entire required mortgage insurance on that FHA loan. And that's something that they've increased numerous times over the last 5 to 10 years. The big difference between that and the Fannie Mae option is there's no self-sufficiency test and there's no upfront mortgage insurance premium. So the overall cost of the loan is a lot lower on the 5% down option. It's much easier to get into one of these. We can go, in the higher purchase price markets, do loan amounts up into the 2 millions on 4 units. So, I mean, there's a lot of flexibility with these where the FHA option was very limited in that sense because of that self-sufficiency test on the 3 to 4 unit side. It's not applied to the 2 units. So like when you bought your place, there was no, 2 units, there was no self-sufficiency test. And so if somebody's looking at a 2 unit, the 3.5% option is it'll save you 1.5% on the down payment, but you end up losing that to that upfront mortgage insurance premium because it's 1.75% that has to be set aside in an account that's divvied up over 5 years.
Yeah, those are great insights right there, especially if you're not, close to this every day or thinking about it all the time, just understanding how these loan products have shifted and changed over the last couple of years. Even for someone like myself, I haven't done that much in the residential multifamily side for a little bit here. So it's great to hear those updates. I kind of made a note because to recap what you said, with the FHA loan, you can still get 3.5% down, but the property has to pass that self-sufficiency test if it's a 3 or 4 unit. That's not required for 1 or 2 unit property for the FHA. However, you do have to pay that upfront insurance premium to cover kind of the PMI basically. So you have
Mhm.
to cover that cost upfront. And again, going back some years when we had our property, because we were able to do those renovations and we also just bought at a great time, we were able to refinance out of that FHA loan after 1 year. So we were able to
Mhm.
eliminate that PMI and actually reduce our mortgage. But for many investors, that may not be the case. You can't bank on creating that kind of equity in a short window. So it's really great. Alternatively, you have that 5% loan product that Fannie Mae has, which does not have the same level of restrictions. And you talked about kind of $1 million, $2 million property. I know the one other downside with the FHA loan when I was looking at it before was it was capped. I could only get a loan for like 400 some $1,000.
Yeah.
So, and again, in the Chicago on the north side, that really limited the kind of properties we could buy at that time. It sounds like with this 5% product, there is no cap as far as the actual purchase price or the size of the loan. Can you just clarify that point?
Yeah, there is. And so
Okay.
it varies by county across the United States. And it ranges anywhere from, like, for 1 unit, for instance, you're looking at a range anywhere from 765 on 1 units to 1,149. And so it goes up at a duplex level, triplex, and a quad. The quad we can go all the way up to, I think the loan amount's 2.2 off the top of my head. And so there's a lot of flexibility when it comes to the loan amounts there when you're buying larger, three or four, two, three or four. So that's the big difference there. And one of the things, that you had touched on that I wanted to mention. So strategy you use when you refinanced out of it, that upfront mortgage insurance premium now, just so people know, is lost. So you now, when you refinance, you don't get that money back. And so there's no refund. So it's just another consideration when you're looking at
Yeah.
FHA loans versus a conventional. And the FHA option still is a great product. It's there to help people get into homes that may not qualify for traditional financing, let's say like a conventional loan. I mean, for instance, we can go down to a 500 credit score now on FHA loans with 10% down, and we're getting a lot of lower credit score approvals through Fannie Mae. So it's just, I like to get that out there that it's that they've made it so easy, and credit is always one of the barriers that people think about, or maybe I don't make enough money. The best advice I can give is start the conversation as early as possible, put a plan in place, because I can tell you how many clients that we talk to, they're like, oh, I found this house and I want to put in an offer, but then we go ahead to put together, start putting together the pre-approval letter, and unfortunately they don't qualify, and it's going to take 3 to 6 months. So the earlier we can get out ahead of that, the better.
No, it makes a lot of sense, and I appreciate you clarifying that. So we've talked about the strategy for those folks who are looking to be an owner occupant of this first property or, getting involved as an investor. Let's talk about folks in the strategies who you're not going to be the owner occupant, whether it's a short-term rental or even a long-term rental, but it is a true investment where you're not going to be living in it. What are some of the products or some of the options and strategies that are available for those investors?
Yeah, so I mean, you can do up to 10 finance properties going conventionally. And so, with the lowest down payment options that are available out there, going the government route through Fannie Mae, are the 10% down vacation home loans. That, I mean, we don't need to get too deep in the weeds and the guidelines with this, but there's been a lot of myths and misinformation surrounding this program. And I just try to get the correct information out there with everything that I do. So with the 10% down, it was never intended to be this quasi investment property loan that short-term rental operators. have you started using over the last 5 to 10 years. And so with this program, the government took a hard look at it and thought about, looked into getting rid of it. They thought about tightening the screws on it to make it harder for short-term rental investors. And what they decided to do was leave the program in place, but make it more expensive and make it synonymous with investment property financing. And so what they did is actually targeted this program and the 15% down option and made them more expensive because these were the two preferred methods to scale for earlier investors to get up to 10 finance properties. And the government knew that. And so what they did is they made these loans more expensive and increased the rate spread on them to slow down investors from buying up the limited inventory that's out there. And so with these programs specifically, the 10% down, it's still available. You can still, use it it's a personal use loan. So when you're using this program, you do need to make sure that you're using the property for personal use for some portion of the year. That's the way the guidelines written. The IRS tax rules 2 weeks. We have confirmed with Fannie Mae, there's no set guidance on this. There's no set amount of days, but we recommend using it 2 to 4 weeks a year to be on the correct side of this and show that you truly intend to use the property as a second home. And then there's no limit to how long you can rent it, doing a short or a midterm rental while you're not there. You just can't do a long-term rental with it because this is not a rental loan. I mean, this is not a true investment property loan. If you intend on never using it for personal use as a second home, and it's truly just going to be a short, mid, or long-term rental, then the minimum down requirement currently is 15% going the conventional route. And by putting that extra 5% down, it takes all of those second home loan restrictions out of the equation, and it turns it into a true investment property loan where we can use the rent to help you qualify. It can be the house next door to you where the second home loan you can't buy it. It has to be outside of 50 miles. The 15% down, it takes all of those limiting factors out of the equation. And one of the nice parts is we can use the rent to help you qualify at the time of purchase. And we can also use the rent between when it's, you purchase it and when it's filed on a tax return. And so it has a much faster speed to scale than the 10% down loan, because that 10% down option, we can't use any rent at the time of purchase, and we can't use any rent to offset that payment until it's on a tax return the following year.
Yeah, I love that. You gave great options and feedback there. So there's two loan products, right? The 10%, which is more of a vacation home loan. You have to be, property has to be 50 miles away from your current residence. It needs to be used, at least 2 weeks of the year for vacation, even though, there's a little bit of gray area, but strong recommendations, at least two, 2 to 4 weeks,
At least, yeah.
just to check the box there. And then alternatively, if you are going to use it strictly as an investment property, then there's a 15% down option where you can actually use that rental income and apply it towards kind of those qualification figures. But now you have the ability to truly just run it and use it as investment property. So you have to bring a little bit more money to the table up front, but you can take the rental income and all of that and apply it towards the property as well. So lots of great information there. When people are looking at these loan options, I mean, what mistake are you seeing too many people make?
That's a great question. A lot of investors try to use primary residence financing for investment purposes, like right out of the gate. I mean, tell you how many investors I have talked to over the years that have told me after the fact that they have used a primary residence loan and never moved into it and then rented it out. The government's looking for this. That's mortgage fraud. I just have to let everybody know that
Mm.
the number 6 team in my industry went down hard here earlier this year, and it's punishable by a lot of prison time. So you just want to make sure you're on the correct side of this. Mortgage fraud is a serious issue. I don't like talking about it, but this is one of the things I like getting out there because the current administration's really been looking for it and coming down hard. So, but other than that, I mean, I would say the 10% down, you just got to make sure again that you're using it properly because intention is everything. Just like the primary residence financing, if you intend to move into it and you do, like in the primary residence, the rule is you have to be in it within 60 days and then live in it for a year. And then, you've
Yeah.
shown intent and then you can go ahead and buy your next primary residence and turn that one into your departing residence and make it a rental property. Same thing goes with the second home loan. It doesn't have to be a second home for until the end of time, but as long as you're using it for personal use, you short term it while you're not there, you theoretically in a year or two you could turn it into a long-term rental if you decide you don't want to do a short-term rental anymore. It's just that first year is really where they're looking for the intent. And you just don't want to end up on the wrong side of this. I mean, we're creating businesses here as real estate investors. You want to make sure you're setting it up on a solid foundation. And my team and I always try to give everybody solid advice. And again, stay away from anything that could be remotely close to the F word there. So that's
And
one
I
of the
think
biggest
that's
things that I
important too,
do.
right? It's, as investors, as entrepreneurs, we're always looking for an edge. We're always looking for ways
Absolutely.
to get a little bit more. But you have to proceed with caution, particularly when it comes to the legalities. And this is just not an area you want to play around with. You
Yeah.
mentioned the number 16 kind of went down. I don't want to get specific into what happened with them
Mhm.
necessarily, but when you talk about, the potential backlash with mortgage fraud, is that something that just impacts the borrower, or is there a potential for that mortgage broker to have some sort of accountability or negative
Culpability.
consequences in that process as well?
Yeah, definitely. I mean, so we're all licensed nowadays, and that was one of the big changes from the Great Recession. I mean, prior to that, there was a lot of people in the industry that probably shouldn't have been, with records and stuff like that. And nowadays, everybody's licensed, and so every loan that we do is tied to our license. And that team, from my understanding, and I've read some of the reports that have come out, they had built a business around using the wrong loan products and stuff for investors, and somehow they ended up getting caught up in an investigation. So it's just, again, it's not my favorite topic to talk about, but it's something that needs to get out there because it's, we're going through a period right now where we have a lot of compliance, and the government is looking for inconsistencies, and all of these loans end up at the federal government level, and so they've got their algorithms where they're looking for things, and you just want to make sure that you're on the correct side of it, and you're again, creating a business on a solid foundation so that way you're not ending up on the wrong side of an investigation years down the road.
No, Jeff, I appreciate you sharing that. Many listeners have options or different contacts when it comes to lenders and who to talk to. Um, Maybe this is something where they just got a buddy or someone they met at a meetup and they just start work with them. But how should we be vetting kind of our
That's,
loan partner? Like,
that is
what
a
questions should I ask? What should I be looking for?
great question. So unfortunately, we just went through a huge shift in my industry, and we're going through the same cycle that we did during, 08, 09, where, there was mass layoffs, company closures. And unfortunately, we've had a lot of people leave the business. And once times get good again, a lot of people jump back into the business for all the wrong reasons. So my best advice is, do your research. I mean, there are a lot of great professionals out there that give solid advice. But there are a lot of people that don't really know what they're doing in this space, because working with real estate investors is the hardest thing you can do in my industry, because it takes a certain level of experience. There's so many nuances. And, we have spent years trying to figure out the boundaries with all of this and asking the questions, calling Fannie Mae and Freddie Mac. I mean, making sure that the information that we're putting out there is correct and that we're not steering people in the wrong direction. And when you're, talking to different loan officers, ask them about their investment portfolio. Ask them about their clients that they've worked with, recent, transactions they've done for investors. Go do some research on reviews. They should have their own personal reviews. Most real estate professionals, whether it's a realtor or a loan originator nowadays, understands the incredible power of social media and how necessary it is for us to continue to grow in this space. So most of us are putting out our investments, what we're doing on. So you can go on there, because I mean, you look at Instagram, YouTube. This is our basically our resume nowadays. I mean, so people can go on there and vet you. And as we continue to move forward, with all of this technology, it's going to be more and more critical. So if you're finding you're talking to a loan officer and you can't find anything online about them, and you're not liking the answers that you're getting, I mean, my recommendation would be to move on.
Great tips there. I mean, we definitely want to see that social proof, asking the right questions and making sure that they have helped other people. It seems so simple, but some people don't do it right.
Yeah.
Ask for proof or referrals of them helping the kind of clients doing the things that you're looking to do. It's not just enough for them to help other people with their loans or they're buying their home. But if you're buying small multifamily or you're buying, short-term rentals or you're buying a vacation home, make sure they have experience doing that because sometimes those little nuances, the regulations, the loan products, they may differ just enough where now this person's trying to figure out how to do it for you. And you want that expert. You want someone who's bringing that level of expertise to the table. They know exactly what to do for you and not trying to learn on your project. So make sure you're asking the right questions about not just their experience and track record, but specifically as it relates to the kind of property and the business plan that you have
Mhm.
for that property. So really great
Yes.
points there.
Well, and that's a big part of it. I'm glad you touched on that, the business plan aspect of this, where there are a lot of LOs that look at it from a very transactional standpoint. They want to, get the loan done and move on. There's others that are the true professionals that will help you plan and put a strategic plan in place and really help you connect the dots on how to build your business as efficiently and effectively as possible so you can scale without making a lot of the mistakes that a lot of investors that try to do it on their own end up making. So it's having that plan in place. The strategic plan is just so incredibly important as you're building your business. And I'm glad you mentioned that.
Yeah, I know you've helped various investors, Tony Robinson being one from the BiggerPockets platform. Um, what do the most successful investors do differently than those folks who are maybe struggling or not getting traction when it comes to working with lenders?
It's a great question. So Tony's definitely the most well known out of my clients, but I mean, I've worked with thousands of investors over the years, and some of the biggest mistakes that I see is always looking for the cheapest deal. I mean, it's kind of penny wise, pound full. Let's try that again. You can edit that out. Penny wise, pound foolish. And basically, what they end up doing is we have a conversation, and they may talk to, go online to an online lender that may be an eighth lower in rate or a little bit lower in cost. And it ends up costing them because it's a nightmare of a process. And I mean, it just ends up being a much larger headache in the long run. And so that's one of the early lessons that most investors will learn, unfortunately, the hard way. And all I say is learn from other people's mistakes in that sense, because if you look at any true investors that have built big portfolios, they have strategic partnerships. I mean, they have their go-to lenders. It may not always be one. Like I haven't done every single loan for Tony. I mean, they're off doing hotels and stuff like that now. So I mean, I don't lend in that space, but what you want to do is make sure that you're asking questions. You've got to be your own best advocate, and you can talk to multiple lenders. I mean, I'm a big advocate of that too. I mean, you want to go out there and continue to ask questions and find the people that you want to work with, because just like with us, we can't work with everybody. There's plenty of great loan officers out there, but as an investor, you want to make sure that whoever you're working with is somebody that's trustworthy, whether it's somebody that's come through a referral, through an investor meetup, that somebody that personally that's done business with them. You can, I mean, I know BiggerPockets has got an incredible lender finder too that they've rolled out that you guys can check out, that I highly recommend. I mean, I've had the honor and privilege of talking to a lot of the investors, excuse me, a lot of the lenders within their network, and they're incredible. So that's a few places that your clients can go, or your listeners can go connect with and find great LOs.
No, I love it. Great tips there. Appreciate that, Jeff. If you want to connect with Jeff and his team, you can go to his website, bpinvestorteam.com. We will link to that in the show notes. Right now, we're going to transition to our round of insights. Jeff, give me a failure or an apparent failure that sets you up for later success.
So looking back, my biggest, I mean, I've had, just like everybody that's around my age, we've had, that's successful has had plenty of failures. The biggest one that I had was back in the early 2010s, kind of hit a fork in the road and decided to try to open a mortgage company with one of my friends during that period. And I had a choice to make, either go all in on real estate investing or all in on a mortgage company. And I realized within a year that it was not for me. I mean, I live for the adventure. I love getting out and meeting people, talking to people. I mean, I'm out, all over the country at different events, speaking and going to meetups nowadays. Back then, I was stuck in an office and I was miserable. And it took me a long time to get to really figure that out, that this is not what I'm supposed to be doing. And so, because of that failure, though, it took me a long time to come out of it. There were more lessons during that period of my life than anything else. And because of that, I'm here today. I mean, I shifted gears, really leaned into what I'm supposed to be doing, which is, building a real estate empire and working with real estate investors and helping people meet their goals and their dreams. And that's been the most rewarding thing about the last 10 years for me, even though I went through hell and back trying to figure out what I wanted to do in life during that period. Um, is that now I get to create opportunities for other people, and I'm changing lives, and I love it.
Love it. All right, give me a digital or mobile resource you recommend for investors.
So the biggest question I get is, where can I go to follow mortgage rates? I always recommend go to mortgagenewsdaily.com. It's a great free industry insider website where you can track where rates are. Mortgage investor rates are always going to be a little bit higher than that, but that's a great place to start. And then, obviously BiggerPockets. I mean, they're incredible. Their investor education that they do is amazing. And so those are the two big ones that I always recommend.
Give me the book you've recommended or gifted the most in the last year.
Sounds good. Yeah. So the book that I have really, that's just absolutely incredible, is Your Next 5 Moves by Patrick Bet-David. I'm not sure if you've read that, but that's all about business strategy, and it is just absolutely incredible. So anybody that's in business, building the real estate business, I mean, this is a great book that really gets you thinking forward about your next moves and what you're going to be doing, instead of just being so stuck in the moment. And then I've got another one too, which is The Obstacle is the Way by Ryan Holiday. You've read that. I mean, it's just absolutely incredible how, when you really put it into perspective, how people will just, when there's an obstacle, people end up, going around it or finding a way, where, the people that are successful in life find a way to get through that obstacle and they don't stop.
What's a daily habit that helps you stay focused on your goals?
5 o'clock club. I'm up every morning. I'd say 4 days a week I'm exercising, other times. And after that, I'm working. And that is kind of the golden couple of hours for me before, my team's on, and, I have space to read, to get creative, and really focus on the bigger picture stuff that's led to a lot of what I'm doing nowadays.
I love it. Give me your number one insight for getting the best loan for your investment.
The number one insight for the best loan. Interesting. That's a great question. I would say, again, start the conversation. You need to find out where things stand, because if you're looking for your best loan, it differs between, by client. Everybody's a little bit different on what they're going to qualify for. Some of our clients are going to qualify for the programs we've discussed. Others have already gotten to the point where they need to switch to DSCR financing or more non-conventional financing. So the earlier you can start having those conversations to figure out where you stand, the better.
I love it. Well, let's lighten the mood. I know you're out there in California. Give me your favorite place to grab a bite to eat.
It's great. Yeah, I live in Laguna Beach, and I'm not sure if you're familiar with Laguna, but there's a place, it's called Hotel Laguna, that has been closed for years, and it was a staple in Laguna. You see it in all the pictures. And they have not opened the actual hotel yet, but they've opened a restaurant downstairs called Larson that's absolutely incredible. The place is amazing. It's right on the water. It's a little more on the expensive side. And then for anybody that's looking for something a little less expensive in Laguna, there's a place called The Cliff that's just up the street from it that almost, has a view where you're looking down over the water, and it's a little more budget friendly than Hotel Laguna. So.
I love it, man. I love it. We'll have to put both of those on the list for the next time we're out in Southern Cal. You gave us a lot of great information, Jeff. Appreciate you coming on the show today, talking about, ways to get started. If you're looking to be a first-time homeowner, looking to invest, house hack, get a 1 to 4 unit property, gave us lots of great tips on the Fannie Mae loan product that's out there. If you want to try the FHA product, that's available as well. But also, if you want to transition and focus just on investment properties, understanding the loan products that are out there for that, vacation loans, the 10% to 15% down properties or loan products that are out there, and just understanding how to get the most value, have those conversations, vet the loan officers that you're looking to work with so you're asking the right questions, and ultimately avoiding any kind of impropriety that might wind up in the wrong side of things here, right? So the whole point of being an investor is to grow your money and not necessarily wind up behind bars. So
Yeah,
making sure you're making
definitely
good
do it the right
decisions
way.
here.
Yeah,
Yeah, exactly, exactly. Again, for folks who want to learn more to connect, they can check out you and your company at bpinvestorteam.com. Hey, I had one last little question, Jeff. So, one thing that I know people tend to focus on when they're looking for a loan for property is the rate. They're always focused on interest rate. It's probably one of the first questions that they ask. Can you just talk about the importance of understanding the terms as well and being able to match the terms to the business plan as opposed to being solely fixated on the rate?
absolutely. Yeah, I mean, I mean, that's a great question. When you call around to different lenders, they're always going to give you the best rate, the lowest possible rate that they offer, and they're not going to tell you the details. So, for instance, like with DSCR financing, for your more experienced investor clients, this is the commercial loan product that's been used on the residential or on the commercial side for years, that's been adapted to residential real estate for business purposes only. So with this product, we're just looking at the property as a business. So we're doing a cash flow analysis on the business. And with this program, like some of the other non-conventional products, this is big pools of money on the secondary market that's lending in this space. This is not, conventional financing. And so there's a required rate of return already factored into this money for lending it. And that money is made one of a couple of ways. And so with these DSCR loans, for instance, they have what's called a prepayment penalty, where it's basically a lock-in period where you can't refinance, sell, or pay down more than 20% of the principal without triggering this penalty. And so with this, they range anywhere from 0 to 5 years. I've even heard of a 7-year prepay recently, which is just an incredibly long period of time to get locked into one of these loans. We on the residential side, we don't even offer anything past the 3 year because there's not enough benefit to the client for extending it out that long. But if you call around to various lenders, they're going to give you their 5-year prepay rate and not explain to you that it has a 5-year lock-in period. And so we now have clients, because rates are dropping, that have taken out these loans over the last few years, coming to us to refinance, and they've got a $10,000 prepayment penalty on there, and they didn't even realize it because they were never told by the loan officer and they didn't read the loan docs. So these are the questions that you need to ask and make sure, is there a prepay? If there is, what are my options? Can I buy it out? What's the cost for buying it out? And so this is the importance of talking to a true mortgage professional that's looking out for your best interest and not just their bottom line, because they're going to be able to guide you in this process and explain the differences and the nuances, so that way you can make your own decision and make sure you're making the right decision.
I love it. Thank you for clarifying that because I think it's such an important thing that sometimes get lost in the allure of interest rate. But understanding your business plan, prepayment penalties, the terms of the loan, all that is really, really important. So thank you, Jeff, for coming on the show today and kind of walking us through the different products that are out there. We look forward to staying in touch with you, and we hope you have a great day.
Great. Thanks, John. Thanks for having me on.